Welcome back, everyone. I am genuinely so pumped for today's explainer because we're putting on our expert investment analyst hats and trying something really fun. We are going to run a pretty fascinating biopharma stock through what I like to call the Guru Gauntlet. Basically, we're putting Xeris Biopharma, ticker symbol XERS, on trial. We'll be using the absolute strictest classic investing frameworks from absolute legends like Warren Buffett, Peter Lynch, and Benjamin Graham, and then we're going to contrast those with modern discounted cash flow and valuation models. It's going to be a wild ride, so let's just dive right in. Okay, here's our roadmap for today. We'll start with a quick snapshot of Xeris, run it through the Buffett, Lynch, and Graham lenses, check out those modern DCF models, and wrap the whole thing up with a final synthesis and recommendation. Starting off with Section 1, a quick snapshot of Xeris Biopharma. They're a commercial-stage biopharmaceutical company focused on chronic endocrine and neurological diseases. To anchor our analysis today, we're looking at a current stock price of $7.93. This gives Xeris, who you might know for therapies like Recorlev and Gvoke, a market cap of about $1.43 billion. Now, this stock has actually been on quite a run lately, up over 133% over the last year. They're definitely scaling up their operations too, with their workforce growing 23% year over year to 510 employees in 2025. But as an analyst, you know we can't just look at a stock chart. We have to look under the hood at the actual business engine. And when we do look under the hood, there is this fascinating financial contrast at play. In Q1 of 2026, Xeris reported total revenue of $83.1 million. That's a huge 38.3% increase year over year. But more importantly, they literally just posted their first profitable quarter, swinging to a net income of $2.2 million. This was heavily driven by Recorlev sales pretty much doubling. They also have a totally solid cash position of $115.8 million. But, and this is a really big but, look at that long-term debt, $221.2 million. That intense tension between this brand new profitability and that incredibly high leverage, that's exactly what our gurus are going to scrutinize today. So let's move right into Section 2, the Buffett lens. Let's see how Warren Buffett's notoriously conservative criteria judge this newly profitable player. Okay, so Buffett demands a few non-negotiable things, right? An economic moat, consistent earnings, high return on equity, and manageable debt. Let's see how Xeris stacks up. Believe it or not, they actually pass the moat test. Their Xerisol technology and specific product patents extend all the way out to 2040. That gives them a serious protective barrier against generic competition, and they're even actively defending this in court right now. However, they absolutely fail Buffett's financial tests across the board. They have this massive accumulated deficit of $669 million, which means historical earnings consistency and ROE are basically non-existent. And that $221.2 million in debt, it completely dwarfs their meager $13 million in equity. Now, we can try to estimate owner earnings using their trailing 12-month free cash flow of $9 million, but honestly, it's just way too recent and inconsistent for Buffett's liking. So looking through the Buffett lens, this is a hard pass. Xeris falls way outside his typical circle of confidence. He usually avoids complex biopharma anyway, and it entirely lacks the decade-long track record of consistent, compounding earnings and low debt that he absolutely demands for a margin of safety. For Buffett to even consider a buy here, this stock would literally need to drop to a tiny fraction of its current price just to create a wide enough margin of safety against that massive debt load. On to Section 3, the Lynch lens. Let's see if Peter Lynch views this differently, since he loved finding multi-baggers in unconventional places. Lynch famously categorized companies into 6 different buckets, and when you look at Xeris, it actually perfectly fits the profile of a turnaround that is rapidly transitioning into a fast grower. Remember that Q1 revenue grew 38.3% year over year, and Recorlev net revenue specifically, that skyrocketed an incredible 95% to $50 million. This is exactly the kind of top-line explosion Lynch absolutely loved to uncover before the broader market fully priced it in. When we weigh the pros and cons Lynch style, that 38% growth rate creates a really favorable forward PEG ratio. Basically, the price you're paying today for that future growth might actually be cheap. On top of that, recent Form 4 filings show active insider buying, which is a massive positive signal for Lynch. But there's always a but. The balance sheet remains a massive con. That high debt load makes this an absolute hold-your-breath play, if interest rates bite or if their growth suddenly slows down. So in the Lynch playbook, Xeris would definitely be rated as a speculative buy. It's a great story, amazing growth, but you've got to keep a very, very close eye on that balance sheet. Moving to Section 4, the Graham lens. Let's swing back to the ultimate conservative evaluator, Benjamin Graham, and check for a margin of safety. Graham's defensive investor checklist is notoriously unforgiving. Does it have adequate size? Well, yes, at $1.43 billion it does, but honestly, that's where the good news completely ends. Strong financial condition? Nope, debt is greater than equity. Earning stability? Definitely not. They literally just posted their first profit. Dividend record? No. Moderate price to earnings and price to book ratios? At a $1.43 billion market cap on just $2.2 million in quarterly earnings and $13 million in book value, no, it fails spectacularly. But as analysts, we can't just stop at the checklist. We have to do the math. Let's run Graham's intrinsic value formula. Now, since they only recently became profitable, we have to make an assumption just to use the formula. Let's annualize their Q1 earnings per share of 1 cent, which gives us 4 cents for the year. Next, we calculate book value per share. $13.011 million in equity divided by roughly 172.55 million shares gives us a tiny 7.5 cents per share. Now we plug all that into the Graham formula, the square root of 22.5 multiplied by that EPS multiplied by the book value. And wow, this brilliantly illustrates the harsh reality of deep value investing. The Graham intrinsic value spits out just 26 cents per share. Yep, 26 cents. Compared to the current price of $7.93, there is absolutely zero margin of safety here. For a Graham disciple to even think about triggering a buy, this stock would literally have to crash to around a quarter. All right, Section 5, DCF and alternative models. What happens when we stop looking backward and start projecting forward? Things get wild here. Let's look at a two-stage free cash flow to equity discounted cash flow model. The core assumption here, based on analyst projections, is that their current $9 million in free cash flow is going to explode to $222 million by the year 2030 as Recorlev really scales up and their pipeline matures. When you discount those projected future cash flows back to today's dollars, assuming a standard weighted average cost of capital and normal terminal growth rates, the fair value skyrockets to an astonishing $41.67 per share. According to this DCF model, the stock is currently 81% undervalued. And if we want to verify this bullishness with an alternative model, we can look at a price-to-sales comparison, which is super common for growing biopharma companies. Currently, XERS trades at a PS ratio of 4.94x, but the fair industry average for this kind of growth profile is estimated at 5.98x. Applying that fair multiple to XERS implies a value of roughly $9.60 per share. So both of these forward-looking models suggest the stock is actually undervalued today. Finally, Section 6. Synthesis and final recommendation. Let's pull all these wildly diverging views together. I mean, just look at this massive spread in valuations. You've got Benjamin Graham's strict asset-based valuation rejecting the company at 26 cents. The general Wall Street analyst consensus sits slightly below the current price at $6 flat. Then you have the current price of $7.93. Our price-to-sales models suggest it should be a bit higher at $9.60. And then the aggressive forward-looking DCF model sees a massive 81% upside to $41.67. This perfectly highlights how your choice of valuation framework completely dictates your entire worldview on a single stock. So, what's the final takeaway from our analyst desk today? Well, let's weigh the facts objectively. The strengths are undeniable, right? They just crossed into profitability, Recorlev is experiencing this massive 95% growth, and their pipeline asset XP821 for hypothyroidism is entering phase 3. But the risks are equally stark. $221.2 million in debt, with complex convertible notes maturing in 2028, and a heavy reliance on uninterrupted fast growth just to service that debt. Blending all these insights together, our final verdict is that Xeris is a textbook high-risk, high-reward speculative buy, specifically tailored for growth investors who lean toward a Peter Lynch philosophy. To wrap up this explainer, your view on Xeris Biopharma entirely depends on your personal investing philosophy. If you demand historical safety and hard assets like Buffett or Graham, you absolutely won't touch this until they pay down their debt and build up some real equity. But if you're willing to project future cash flows and bet on their continued commercial execution, well, the upside modeling is tremendous. So I leave you with this question to ponder today. Are you a backward-looking value investor or a forward-looking growth investor? Thanks so much for joining me in the gauntlet today, and I'll see you in the next explainer.